Hello, my name's Sarah Wheeler and I'm the head of the Anti-Money Laundering Division here at the Cayman Islands Monetary Authority, and today I'd like to talk to you about our recent sector-specific risk assessment of Trust and Company Service Providers, or TCSPs. Today's presentation really has three parts. The first is looking at the purpose and background of the risk assessment, including the methodology used, the definition of TCSP, the context of our combined sectoral risk assessments, and the timelines. Then we'll look in closer detail at the actual inherent risk summaries, looking at nature, size and complexity, clients and customers, transactions, products and services, delivery and distribution channels, and geography. And then we'll look at the combined overall risk rating. Finally, we'll look at the key takeaways for you as licensees and regulated entities, and how you can best use some of these findings to enhance your own approach to managing and mitigating money laundering and terrorist financing risks. The purpose of the TCSP risk assessment was really twofold. One was to identify and assess money laundering and terrorist financing risks connected with TCSPs, but also to evaluate those risks. But this applies not just to the Cayman Islands as a jurisdiction, but also to us as a regulator and to you as licensees and regulated entities. The risk assessment methodology looked at inherent risk factor ratings, and those factor scores have been consolidated into a final overall inherent risk. The inherent risk factors comprise nature, size and complexity, the structural risks associated with the sector, transactions, products and services, delivery and distribution channels, clients and customers, and underpinning all of those four elements, geographical risks, and we'll describe in more detail what those categories mean. But first, let's consider the definition of TCSP. TCSPs in the Cayman Islands are licensed and regulated by CIMA in accordance with the Companies Management Law and the Bank and Trust Companies Law. TCSPs can be broken down into CSPs and TSPs, corporate service providers or trust service providers. There are two types of corporate service provider licenses: companies management licenses, usually corporate management and discretionary services such as directorships, and corporate service provider licenses. Those are usually registered office and accommodation services. Looking now at TSPs, there are three types of trust service provider licenses: trust licenses, which then are further broken down into full, restricted or nominee types, controlled subsidiary licenses, and private trust companies. This risk assessment of TCSPs, which throughout will make a distinction between CSPs and TSPs, was part of a combined set of sectoral risk ratings that was conducted by the authority over the course of last year and early this year. And that contains a summary of all sectors, so banks, MSBs, TCSPs, insurance, mutual fund administrators, securities licensees, and civil EPs. The prompt for doing so was really from the National Risk Assessment conducted in 2015, which identified a need for enhanced supervision of TCSPs, and then the CFATF Mutual Evaluation of 2017, which confirmed these findings. And as I described before, in 2019, the authority conducted a comprehensive AML-CFT risk assessment for TCSPs. The TCSP risk assessment was drawn from data collected during an exercise in the latter part of last year. And the overall risk ratings for each inherent risk factor are set out here, and you'll note that we have distinguished between TSPs and CSPs throughout. And I'll talk through the specific findings under each of these inherent risk factors over the next sets of slides. First, we looked at the nature, size and complexity of the risks, the structural risks. And the key risk factors considered here were whether there's a physical presence in the Cayman Islands, the complexity of the group structure, the non-regulated business, parent companies, affiliates or subsidiaries in higher risk jurisdictions, or whether the principal place of business was in a higher risk jurisdiction. And for both TSPs and CSPs, the risk was deemed medium-high. And the reasons for those medium-high risk ratings are as follows. TCSPs are used in sophisticated cross-border commercial transactions, such as tax, financing and private asset structures, established for the purpose of preserving and managing private wealth. Although there are only 477 TCSPs in the jurisdiction, they utilize in the shared management of approximately $694 billion across multiple sectors, so their impact is significant. The complexity and the size does lend itself to a higher risk rating, and it's worth mentioning that nominee trust licensees and controlled subsidiaries will carry the same risk as the parent that holds the trust license. TCSPs do typically maintain a physical presence in the Cayman Islands, but a small number of TCSPs provide registered office-only services. These pose a higher risk to money laundering. However, most TCSPs provide discretionary service as well, which mean that the TCSP has a better understanding of the beneficial owner for whom it's operating. So let's look now at client and customer risks. So the key factors considered when looking at the inherent risk factor under this category is both the type of client and customer and the number of clients and customers from high-risk jurisdictions viewed as a percentage of the total. A different risk scoring was given for TSPs than to CSPs in this category, and I'll explain why. Only 0.05% of all TSP customers come from high-risk jurisdictions. Approximately 5% of those fall within higher risk categories, namely non-profit organisations, corporate trust nominees, and special purpose vehicles, high net worth individuals, high net worth corporates, sophisticated persons, and politically exposed persons. Indeed, 32% of all TSP customers are high net worth individuals. Given the TSP sector is so much greater than the CSP sector, although 7% of all CSP customers come from a high-risk jurisdiction, only 0.02% of those are high net worth individuals, and this, coupled with it being a much smaller market share, gave it the lower risk rating. Moving on now to transaction products and service risks. So what are the types of service that are offered by TCSPs? Well, there's trusteeships, provision of registered office-only services, investment management, allowing nominee companies to settle trust, allowing clients to control accounts, non-discretionary trusts, and facilitating non-regulated financial activity. So these are all potentially high-risk activities. We also looked at the forms of payment accepted. And the conclusion was that TSPs were at high risk for transaction products and services, and CSP at medium-high. Looking more closely at the transaction product and service risk, we can see that there are a number of higher risk services connected with TSPs. These include trust licenses, restricted trust licenses, nominee trust licenses, and controlled subsidiaries. From an AML-CFT perspective, it's important to note the difference in the risk associated with nominee trust licenses and a restricted trust license. Restricted trust licenses are typically granted in respect of a single family or a small group of families for private wealth management purposes. A nominee trust license is a subsidiary of an entity that holds a trust license, and it provides nominee services to its parent. CSPs, by contrast, offer corporate administrative services. The primary services offered by the TCSP sector are as administrator, enforcer, executor, protector, trustee, director, and registered office services. The risks associated with the products and services offered by TCSPs are, of course, impacted by the potential for opacity. TCSPs can be used in sophisticated cross-border commercial transactions, such as tax, financing, and private asset structures that are established for the purposes of preserving and managing private wealth. The provision of trust services from TCSPs can vary from low risk to high risk depending on the nature of the trust. Certain trusts may be considered lower risk trusts, such as those established by parents for the benefit of children or vulnerable individuals, to more complex structures where the source of trust funds is unclear. Providing registered office or business address facilities is considered higher risk where the TCSP is not providing other TCSP services to a client, i.e. no other business relationship. This service allows the entity to maintain a physical footprint in the Cayman Islands, but can distance that entity from the other assets and activities controlled by the beneficial owner. Only 6% of TSPs and 19% of CSPs provide registered office or business address facilities only in the Cayman Islands. However, these are regarded as high risk. We will now consider the delivery and distribution risks associated with TSPs and CSPs. When looking at these risks, we consider client-customer onboarding and interaction, whether that's face-to-face or non-face-to-face, the use of intermediaries, eligible introducers, and/or the degree of reliance on third parties, and whether customers are accepted via the use of online platforms. TSPs were considered to have a medium-high risk for delivery and distribution risk, and CSPs a medium-low risk. And the reasons for that conclusion were as follows. First, a slightly higher proportion of TSPs have activity that's non-face-to-face, 77% of TSPs, versus 62% of CSPs. TSPs also tended to use introducers more often, although introduction within the group was common. Lawyers are often the introducers, 82% within the TSP subsector, and of the introduced relationships with lawyers, 72% were Cayman Islands lawyers. Across the whole of the TCSP sector, less than 2% used online platforms. So a distinction was drawn given the larger size of the TSP sector and the increased propensity to use non-face-to-face and introducers. Finally, let's consider geographic risks. So factors considered here were whether clients and customers were based in or controlled by persons from high-risk jurisdictions, the services carried out in or from high-risk countries, the services outsourced to countries where AML-CFT systems are not equivalent, and whether there was a large international client and customer base. For both TSPs and CSPs, this risk was deemed medium-low. And this was because the data suggested that the exposure to high-risk jurisdictions was relatively low. For example, only 4% of TSPs and 2.5% of CSPs had parent companies in high-risk jurisdictions. 5% of the owners of trust companies were in high-risk countries. 2% of countries of owners of corporate service providers were in high-risk countries. And only 2.5% of CSPs and less than 1% of TSPs have subsidiaries or branches in high-risk jurisdictions. On this basis, the risks were considered medium-low. So what key takeaways can entities get from this risk assessment, and how can they use the findings to better enhance their risk-based approach to managing and mitigating money laundering and terrorist financing risk? Well, entities can consider the risks associated with providing registered office or business address facilities only, transacting with PEPs, non-profit organisations, corporate trust nominees, special purpose vehicles, high net worth individuals, high net worth corporates, sophisticated persons and or multi-ownership structures, conducting non-face-to-face and having no direct customer interaction, and of course conducting business with persons in high-risk jurisdictions, having regard to all the relevant information including up-to-date sanctions lists. TCSPs should factor the TCSP risk assessment into their institutional risk assessments, ongoing monitoring, staff training and compliance programs. And TCSP should also ensure that their data, records are up to date, accurate and available for inspection. Implementing an effective risk-based approach to managing and mitigating your money laundering and terrorist financing risks requires 4 key components. The first is the identification and assessment of risk, and that's where this risk assessment can be really useful to you. The second stage is managing and mitigating those risks by identifying and applying the appropriate measures, and that can take many forms. It could be by using enhanced due diligence, it could be by requiring senior management approval for certain transactions or activities, you could have certain limits on certain activities, and also you have your education and training programs internally in your compliance team. Then of course you have your ongoing monitoring, whereby you need to implement policies, procedures and IT systems to make sure that emerging risks and changing profiles are captured and fed into the risk profile for all of your clients and customers. Finally, you need to document those risk assessment strategies, policies and procedures, and where you have reviewed those and where you've made changes, document that too, so that third parties like the regulator can see those upon request and understand the process that you've used. In addition to this risk assessment on TCSPs, there are a number of useful resources and references that you might like to look up. We have our combined sectoral risk ratings, which, as I mentioned earlier, covers all the sectors that CIMA supervises. There's the UN sanctions list, the Basel AML index, and various FATF publications which will help you recognize and understand the risks that you face. And finally, there's a guidance note that CIMA has produced, which give a lot more flavor around your obligations under the AMLRs. Thank you for listening to these slides. If you have any further questions or queries, please do not hesitate to contact us on contact@amlcft@cima.ky.